so I am excited to announce our first speaker for today, Jennifer Baker, and she's going to dive into cash balance plans. Now, Jennifer is the founder of Baker Wealth Strategies, and she's our platinum sponsor for today's event. She has built a firm that partners with tax professionals to build their clients' wealth by using also her CPA license that she has. She understands tax issues and can speak the same language to the clients. So her team's quick to respond and go the extra mile for their clients and partners. So Jennifer, welcome. I'm going to turn it over to you, and please take over and show us what you got.
Thank you. Am I supposed to share my screen for the slides?
Yes.
Okay, I think you need to stop sharing so I can share. There we go. Okay. All right. Can you see my slides now?
Yep.
Okay, great. Well, thanks for having me. We're really excited to be on this conference, be able to talk to everybody. Love the pump up music and seeing everybody's responses to everything. So we're going to get started talking about cash balance plans today. This is our team. Like Dave said, we are very used to partnering with tax professionals to help them implement this strategy in their tax plans. I am a CPA, but we do not do any tax planning of our own. We leave that to you guys. We just want to come in and help you implement the cash balance plan. So to get started, what is a cash balance plan? It's really just a retirement account for your clients. But they can put a lot more money than you're used to being able to put into like a 401k or a SEP. So there's really two kinds of retirement plans or qualified plans. One is the defined benefit. That's going to be like you're used to with a 401k, where people can put money in, it grows to whatever it grows, and that's what they have at the end. The defined benefit is the opposite of the defined contribution. So with that one, you have an end result in mind. So for a typical defined benefit plan, that's a monthly benefit that's calculated at the end. The only difference with a cash balance plan is that we're talking about a lump sum amount at the end. So that's your cash balance that you'll have at the end. This is for your clients who are looking for large tax deductions. This is for those clients who come to you, they have a 6-figure tax bill, and you've got to figure out something to help them. All of the contributions are made by the employer. So you can think about it like a SEP, where the employer is the only one putting in. There's no employee contributions to this plan. And then the contributions amounts are determined by actuaries. We have to bring in specialists for that to calculate, because it's based on age, wages, and some other variables that they have to calculate. So this is a lot of information on this slide. I'm not going to go through everything, but I know the slides are going to go out after, so I wanted to give a lot of details. The main points I want to hit here are that these plans can be very flexible. I know that's a little bit different than a typical defined benefit plan. Usually they're very rigid, and you have to have a certain amount that you're contributing every year. This one can be flexible. So if the business owner has a really good year, we can design the plan to be able to contribute a lot that year. And then if the next year their business is down, they don't have as much cash flow, we can pull those contributions back and lower them, or even freeze the plan. So just because an owner, most of our business owner clients, they don't know exactly for the next 10 years what their cash flow is going to be. So this way you're not tying them into something that they have to commit to for a certain period. We can be flexible each year with those contributions. The other point I want to make is that this does have a cost. And so that's why we usually like to see these contributions of at least $100,000 a year, because you have to pay for the actuary fees and the TPA services. There's fees that go into calculating the amounts they contribute, doing all the reporting on the plan. So to offset those fees, we want to make sure that they're going to get enough of a tax deduction. And so we usually see that efficiency come at $100,000 and more. Part of the money that they put into this plan, we reposition into the tax-free bucket. We call it an exit strategy. Whenever people put a lot of money in a tax-deferred account, they're running the risk that tax rates go up later. they're going to have to pay more tax when they pull money out of the account. So there's really two tax codes that we can use when we're looking at a tax-free bucket. That's the Roth and life insurance. So with this, we're able to use life insurance to have an exit strategy similar to a Roth conversion, but at a discount. So I'll go into a little bit more about that in a minute. And then the last point is that these cash balance plans can be set up and funded all the way until the business owner files that tax return, the business tax return. So that's all the way to 9/15 with extensions. So this is one of the only strategies that I know of that you can do after year end. So this is the part of the year where you're going to be reaching out to all your clients, trying to get them to do tax planning before year end. A lot of them aren't going to pay attention. They're going to ignore you. And then once you tell them how much they owe in April or the beginning of next year, they're going to freak out and want to be able to do some planning. So this is something that you can go back and still implement and save them money all the way till they file. This is a little bit about the structure of how these work. There's lots of different accounts that go into the cash balance plan. They can be paired with 401ks and that match. So a business owner may already have some of these defined contribution accounts set up. They may have a 401k, they may already be matching, they may even have a profit share account. So the cash balance plan can go on top of all of this. The cash balance plan part will be the pension account, which is the that's the investments that the cash balance plan holds. And then the life insurance, which is that exit strategy. So those are the part that go on top of these defined contribution accounts. So some of the reasons that we put life insurance into this plan is that they can actually, the business owner can contribute more to the cash balance plan if you're using life insurance in there. It's a way that the value of life insurance is a little bit different than investments. And so you're able to contribute more on the front end. It also allows you to fund the life insurance policy with pre-tax contributions. So this is not deducting life insurance. This is just using money that's in a qualified plan, taking some of it and putting it towards the life insurance policy. Then we structure that policy in a specific way to delay the growth until after 5 years. It follows a 5-year index on the S&P. So none of the growth hits until after or at the end of the 5th year. We also accelerate all of the expenses. And so what that does is it gives an artificially depressed value in year 5. And at that point, the business owner buys the policy out of the plan. So they're able to get a significant discount. And then all the growth and everything later is all tax-free. So they can take distributions tax-free, all the growth is tax-free. So it's a way to get those tax savings now, but also get the tax benefits later with that second efficiency of buying that policy out. Okay, so the ideal client that we're looking for is really someone who can contribute at least $100,000 a year. That's really the only one on this list. It's kind of a non-negotiable. If they can't at least contribute $100,000, then it's really not going to make sense for them with all the fees they have to pay for the actuaries and the TPA services. So if a business owner can contribute $100,000, the other things that are going to make it more efficient, which make it an ideal client, is one is a low employee ratio. There is a cost to funding the plan for your employees. With qualified plans, the IRS requires the business owner to fund some for their employees as well. And so in doing that, there's going to be some money that has to go towards the employees. So we usually see the most efficient for at least lower than 15 employees for each owner. And so if it's a husband and wife, you could go up to 30 employees. And we can run the numbers and try to keep it as efficient as possible, but that's usually a kind of a starting point, the 1 to 15 ratio. The contributions are based on ages and wages. So the closer the owner is to retirement, the more they're going to be able to fund each year, because we have that set target at the end of the plan. So the younger they are, that means they have a lot more time to grow those assets. So they're going to be able to contribute less now. So if they're 50 and above, that's when we see the highest contributions that they're able to make. Under 40, we can definitely still contribute, but it's just that we may be closer to 100, 150,000 instead of like 300,000 for the owner. We want to see some consistency to their cash flow. It doesn't have to be exact. Like I said before, it's flexible. They can contribute a different amount each year, but we do want to know that they're going to be able to contribute over time. We want to be able to, normally we design these plans for 10 years of contributions. We can do it shorter, 5, 7 years, if we know that they don't want to fund it for the full amount. But we do want to know that their business is not just a 1 year high income and that's it. We want some stability over time. With that being said, we can do some planning if they do have one really big year, like whenever they sell a business. We can even do some planning where we can do an off calendar year and then make it to where they contribute for 2 different years in the same tax year. So 2 years for the plan, but 1 tax year, which means that if they have a really high income from selling their business that 1 year, we can try to maximize all of the deductions for the cash balance in that same year. Okay, some other benefits that come with the plan is, one is that this is not something that's a gray area. So this is really good for your conservative clients who don't want to pay tax, but they're also not willing to do any planning that's going to risk increased audit scrutiny, or they just get nervous about some of the planning. This is very black and white. This is a qualified plan. All the rules are very set. So there's not really anything that the client has to worry about. Even with including the insurance in there, the insurance gets valued by the carrier before the owner buys it out. So there's not any scrutiny on the fair market value. That comes straight from the carrier. The business owner writes a check for that amount. They take the policy out. So there's no fuzzy lines there. It's all clear cut. This can also be open to something where you can go out and market and try to find these higher business owner clients. This is something that is a 6-figure deduction. So this is something where you can go out and target your practice, trying to find those kind of business owners who have that kind of income. And then one last point is that this is a qualified plan, so you are able to use those tax credits available from the Secure Act 2.0. So they can get some benefit the first couple of years they have the plan, just like they could if they had a 401k or any other kind of qualified plan. So I want to show a couple of case studies just to show kind of the power here. The first one is a single owner. This was a CPA that came to us last year in September. He had an employee or a client who was a doctor in California. It was a new client for him, so he hadn't been able to do any planning previously. So this doctor was actually going to have to put $881,000 on his Schedule C, pay self-employment tax on all of that, pay all the income tax on that. So he was really trying to find something where he could lower this client's tax bill. So what we did is we designed a plan where he was able to contribute a little over $400,000 to this plan. $239,000 went into the investment account. $168,000 went into the life insurance exit strategy. We were also able to utilize a little bit of pre-funding. Pre-funding means that you're kind of borrowing from future years to be able to contribute in 1 year. So it does reduce the contributions later. But like for this client specifically, we knew that next year they could file an S Corp election or a C Corp election, but the previous tax year, there was no other planning we could do. So we wanted to accelerate all the benefits we could. So he was able to contribute that full $639,000 in that first year. What that meant is that he was able to save over $300,000 in taxes. And then over the 8-year life of the plan, he was going to be able to save $2 million. So he was able to save a lot of taxes. The CPA was really happy because he really didn't have anything else he was going to be able to do for this client. So it was a huge win all around. The second case study is showing when the owners have employees that they have to pay for. So this was a husband and wife. The wife was 50, the husband 59. They have 9 employees. They had 5 million in revenue, so they had plenty of cash flow. So they wanted to be able to put the maximum amount that they could, but they also wanted to make sure that they were being tax efficient as far as keeping most of the contributions for themselves and not having to contribute too much for their employees. So this is what we ended up designing. So the husband and wife were able to contribute 400,000 on their side. We had to contribute some for the employees, but what we did is we put most of it over into the profit sharing account. The profit sharing account still satisfies the requirement to contribute for the employees, but it takes away the risk because once you put it into the profit share account, it's going to grow to whatever it grows, and those employees just take the balance at the end of the plan. With the pension account, this is the one where you have a set goal that at the end of the plan that you're required to pay for the employees. So there's a little bit more risk there for the owner to make sure that those contributions grow at the designated rate. So we try to keep that account to a minimum and fund most of the employees in the profit share. So the end result was that the owners were able to contribute a total of 542,000. They were able to keep almost 95% of that for themselves. So they only had a small employee cost of about almost $31,000, but they were able to save over $200,000 in tax. So they were happy to contribute that part to their employees. That the employee contribution is still subject to a vesting schedule. So the employees have to stay for 3 years before they get to take it. So it's something that the owner can give to their employees as a benefit, something that that the employees see as value, but the owner is still able to keep most of that contribution for themselves. So here's some frequently asked questions that we get. I'm not going to go through all of these right now, but they'll be on the slides whenever they send them out later. The process whenever you have a client that you think might be interested in this plan, what we'll do is you can either, I think that there's a calculator in Tax Plan IQ to give you a rough idea of what you would be able to fund for your client. You can also email us and we can give you that rough estimate ahead of time for you to put in your tax plan. Then once you meet with the client, you present the tax plan, then we can come in and have a short meeting with the client. We'll go through like a 10-minute, just an overview of what a cash balance plan is, make sure that it's something that fits for their goals, and try to understand how they want us to design the plan, because we have flexibility on contributing to certain employees or excluding certain employees. And so we want to make sure we get all that information up front. Then we'll go get a proposal from our actuaries. We'll come back, we'll present it to the client. If they like the plan, they like the design, then we'll send it over to them by DocuSign for them to sign off on. Then we can start opening their accounts, getting the account funded, start the underwriting for the insurance, and then we'll also get back together once a year to see what they want to fund for the next year, design that plan. So we take all of this for you. Our goal is to make it really, really easy. We know how busy business owners are, so we try to be very efficient with their time and make this as easy as possible. So if you want to contact us, you can either go to our website, bakerwealthstrategies.com, and then under our services, we have a partnership area where you can click on that and schedule a meeting right there. You can also email us, bwsteam@bakerwealthstrategies.com. We're very responsive. We'll get back to you and figure out how we can help. So Dave, are there any questions that you saw throughout the presentation that you wanted me to answer?
We do have a few coming in. We've got a couple minutes. I will reiterate, everyone, we're taking note of all your questions. Please make sure you put them in the questions box or the questions tab as we go today. If you put them in chat, we may miss them. So make sure you put them in questions. We'll get to a couple now, and then again, at the end of the day, we've got the panel where we're gathering all of these for. So let me pull it up and take a look at the list so far. Do you need to be an accredited investor to make use of this plan?
No, no, this
Okay.
is just a qualified plan.
Do they have to contribute for all employees?
They have to contribute there's rules as far as to keep them in compliance. It's not necessarily the same for all the employees. So if someone is highly compensated, you may not have to contribute as much for them. So there's different rules associated with it. You do have to contribute to your employees, but it's not the same amount for each employee.
All right. Do you normally use IUL over whole life?
We do. You don't have to. You can use whole life in these plans, but the way that we design it is to keep the value as low as we can in that first 5 years to be able to have the lowest buyout value. So IUL is flexible in being able to control that a little bit. We're able to accelerate all the expenses in the first 5 years and delay the growth. You just can't do that with whole life. So it's just a little bit more efficient to use IUL.
Can clients that already have a 401k plan in their business participate in this or contribute to this?
Yep, you can add this right on top of a 401k. And then we can either take over the 401k plan and administer them both together, or we just would need to get certain reports from the TPA on the 401k at the end of the year to be able to file some of the cash balance plan reports.
You may have covered this in one of the other ones, but do they have to contribute a certain percentage for the employees?
There are certain compliance rules. It's not a flat percentage. I'm honestly not sure the actuaries do all the exact calculations, but it usually works out to about 7% of the employee's pay. There's some different levers as far as how much to each employee, but that's kind of a general idea.
Excellent. I see a number of questions coming in, but we are right at the end of the time for this session. So we'll keep them coming, guys. We will make sure that we keep track of them, and we'll get to them throughout the day and at the end of the day as we can.